fundsupermart.com.
The China market has been one of the best performing markets comparing to global equities year to date. So in regards to that, what will be the next catalyst that will drive the market moving forward?
What you see now is that there's a reason why the market has moved up so much in China. The key reason is that the economy data since 4th Q of last year has been showing improving data, and it's been very consistent until towards this year. Okay, so that's one of the reasons the market will continue to be stable in a way. The growth will continue to stable. And the second reason why there will be a catalyst for China to continue to move on is the stock connect that is happening now. Right, you have seen Shanghai Hong Kong Stock Connect happened, and subsequently comes to Shenzhen Hong Kong Stock Connect. Okay, and what you are seeing now, the trend is that there are more and more funds flowing towards southbound. Southbound simply means the Chinese funds are actually flowing to Hong Kong. Okay, and that will support the market. And the third thing is that the valuation in Hong Kong is still relatively cheap if compared to the A-share market in China. And probably the other points that I would like to point out will be the earnings growth. Right. I think for the last easily 2 to 3 years, you are seeing earnings growth in China has been on a negative trend. Okay, but the recent announcement is that the recent survey has been shown MSCI China is given a double-digit growth for 2017 and 2018, and that could be a boost for the catalyst in terms of the valuations in China. And further to that, you are seeing also the small to mid caps valuation in Hong Kong is still relatively cheap compared to the big caps, or even compared to the small and mid caps of those companies listed in China. So that makes the market have more ample of room to move on. And the last one that I'd like to mention, despite all these things happen, you are still seeing that the foreign foreign funds are still underweight. Foreign fund managers are still underweight China until today. All right? And like I always mention that China, when it comes to changes, okay, China can change very fast, okay, and any revolution, they could actually make it very fast to happen. But for the global to accept things has changed in China, it always takes longer time. All right, so there's no surprise, despite 4th quarter until today, the earnings, the economy data has been very healthy in China, yet you are seeing that foreign funds are still underweight China.
So quoting from the answer that you have mentioned earlier, the economic data coming from China has been relatively healthy. So some of the reports have actually mentioned that the economic data from China is hitting the peak. So what is Manulife's view on the market moving from here?
I think that actually very much related to, when we talk about economic data, many of people actually refers to the PPI. Okay, and the GDP growth, because the first quarter China registered 6.9%, and a lot of people say that it's not going to be sustainable. And PPI is very peak because we are coming from very low base last year, and towards second half, expectation is that because the base is adjusted higher last year, so the PPI is not going to be sustainable. But what you're seeing, I do agree in a way that you will not see the kind of pace of growth like what you see in the first half. But having said that, that is not a sign of slowing down or a sign of going into negative trend. Okay, the growth will still be there, but probably will just be moderate down, so that you will not see a drastic growth, but it still will be on a growth trend.
Having touched on the world's largest economy in the world, so let's move on to the world's fastest growing economy in the world. So in regards to India, I believe the most spoken topic by investors will be the GST, which has been implemented less than 2 weeks ago. As it is quite common in many parts of the world, the initial implementation of GST will usually lead to hyperinflation as well as a low consumer sentiment. Will this impact the market's performance of India in the second half of 2017? So what is the worst case scenario as a result of GST implementation?
Okay, I think we'll break down a few things so it's easier to understand. The first thing, when we talk about hyperinflation because of the GST implementation, I mean, you're right to point out that a lot of countries will just implemented GST. You see a very high inflation, or certain countries will have hyperinflation because of the GST. But India is a little bit unique in the sense that you will not probably see a very high inflation in the country. The reason why is because tax is nothing new in India. Things that you are buying now from the formal economy in India are all paying tax. All right, the tax will be charged by the state's government as well as the federal government. There are two taxes in that. GST implementation will just be standardized the whole states, the 29 states in India, with one single tax regime called GST. All right, and the tax being implemented is not supposed to be higher than the two tax, the states and the federal tax combined at this moment. So GST is not supposed to be seen as a burdening to the people, okay, for most of the goods, yeah? Not all the goods, but most of the goods. So as such, inflation or very high inflation or hyperinflation might not happen in India, okay? And even for that sake, the recent announcement in the month of June, year-on-year inflation has been actually an all-time low. All right. So, and that's also the reason why the market is expecting that towards August, the central bank in India could actually has a chance to cut interest rate to stimulate the economy. And to your second question, that what is the worst case scenario that potentially could happen to India after GST implementation? What we actually has record some data which showing that some of the companies, or I would say some, right, of those factories has actually stop buying inventories, right? So from April onwards, you see some factories have stopped buying inventories. The key reason why is because they know upon implementation of GST in 1st of July, okay, they can claim input tax credit, right? If you were to buy prior to that, you can't claim. So what it means is that, I will hold on until the GST being implemented, then I will start to restock my inventories. Right? I read some of the articles were saying that some factories actually have destock, okay, clear stock as much as 80% of their inventories. So what it means is that you could potentially see a slowdown in the economy in the April to June period for India economy data. So, but that don't be alarmed with that, because we believe in the month of July onwards, everything will still be back to normal.
You have shared with us numerous catalysts that are available for India over the past 2 years. So it seems that GST is the major and last catalyst for India at this juncture. Given that GST has been implemented now, what will be the next catalyst that one can expect from the India's economy moving forward?
Very tough question. You see, what happened is that we have shared for the last 2 years. We have been sharing, one by one, the plans has been laid down by the government, and one by one, you have seen it happen. And apparently, some seems like GST, is the last one initiative coming from the government. But having said that, what we are seeing is that this will be the beginning of a formalized economy in India. You see, data has been showing that reports have been showing that around 50% or more than 50% of the economy in India are make up from all those informal economy. Informal economy means is that things that people purchase or you do that you don't pay tax. All right, has not been reported to the government. So by having GST, like I mentioned earlier, you have an input tax credit, and more informal economy will want to participate into the formal economy in order to benefit from the input tax credit. And furthermore, now that most of the bank's account are being tracked by the government, you cannot simply just say that from outstanding balance of 100,000, some billions of dollars become into your account. You create a alert. So it's more reason for them to actually participate in the formal economy, to declare rather than non-declare. So imagine that if your economy all this while has only been 50% been taxed, and suddenly now you have more, another 50% emerge. It simply means that the government will have more revenue. When government have more revenue, they will actually spend more infrastructure on infrastructure. Okay, that will actually be a catalyst to move India forward. Okay, especially all those branded stuff will actually become more prominent now compared to those days. Okay, and besides that, we are also seeing. I think everyone knows it's not a secret that Indians like to buy gold. Okay, and to a certain extent in India, gold are used as part of the money laundering. Okay, and the government knows about it, and they've been actively clamping down on this kind of gold purchase, and it makes people start to shift their appetite, move their savings, investment savings, instead of to gold, and start to go to equity market via mutual funds or even the investment link. So there's been, we've been a very healthy growth of the mutual fund AUM or even the investment link AUM so far this year. And all these funds, if you move to the equity market, right, you will somehow have to have more domestic fund flow than relying on foreign fund flow. And that will help to stabilize the stock market. Okay? And what you are seeing is that when you have domestic fund flow, bear in mind, these are all periodic investment. You buy mutual fund, you buy your investment link, you pay on periodic. So what it means is that you will have a continuous inflow of funds into the stock market. It's not like touch and go, but it's rather than continuous. And that could help to stabilize the market moving forward.